They've got to employ and engage advisors, but they have to make sure that they are educated consumers, always questioning, always asking, always seeking out alternatives that advisors may not present to them because they're not incentivized to do so.
Welcome to the My Future Business Show, where we get you in front of your best audience and keep you there. Not only are we interviewing the biggest names in business to help you become even more successful, we're inviting you to book your spot on the show to help you grow your business. So at the end of the call, make sure you fill in the interview application form at myfuturebusiness.com/interviews. Hi and welcome to the My Future Business Show. My name's Rick Nuske, and on the line today I have with me Bernard Reisz. He is from 401checkbook.com. How are you, Bernard?
Great to be here, Rick.
Yeah, it's wonderful to have you here. We're going to be talking about the traditional finance advisory model and why it's broken. But before we jump into that, Bernard, I'd love to learn a little bit more about you, where you're from, and what you like doing when you're not in the workplace.
So I am by professionally a CPA and as well as licensed for securities and insurance products. And my interest includes all financial products and services with a specific focus on seeing how they integrate, how they all come together, which is probably a discipline in itself. When I'm not working, I like reading tax code and spending time with family.
Bernard, why do you think the traditional financial advisory model is broken? Could you share a little bit about that with us?
I'd be glad to. The traditional financial advisory model is very fragmented. You've got a hodgepodge, a patchwork of folks that are advising. Financial advisor focuses on his slice of the pie. The CPA accountant focuses on his perspective.
Yep.
And life insurance professional focuses on his perspective. So the primary issue that I see is that it's fragmented, and nobody's there to see how they all come together. And oftentimes, the strategies that each of them will recommend will conflict with what another advisor is presenting. That's what I'd say is the primary issue. A secondary and related issue is that everybody, and that to one extent or another, it's all of us, we're in a sales role. Everybody's got a product to sell. When it comes to insurance salesmen, then we're accustomed to thinking them as salespeople, and we're more perhaps cognizant of the fact that it's caveat emptor. You've got to watch out, do your due diligence. When it comes to financial advisors, they also carry this name, advisor. But many of them, not all, but many of them are really just financial salespeople. They just got a different product to sell.
Yeah.
It's an insurance product. And likewise for accountants. It may shock people, but if you take a step back, accountants are selling tax return preparation, payroll filings. They benefit the more compliance work you have, the more tax prep work you have. That's more for their bottom line. So each one of them has a product that they're selling to one extent or another. So that's a secondary issue, and I think it's really related very much to the first one.
How is the best way to go about addressing these issues?
The key that I think is, obviously you've always got to do your due diligence and looking at a Better Business logo, doing your due diligence just to make sure a company is legitimate, they're accredited, credentialed, and they're really who they present themselves to be. That's obviously the first step in any undertaking that anybody does. But beyond that, I think really there's no substitute today for any individual taking responsibility for their own finances. They can't subordinate their judgment. They've got to employ and engage advisors, but they have to make sure that they are educated consumers, always questioning, always asking, always seeking out alternatives that advisors may not present to them because they're not incentivized to do so. So the 401checkbook.com, that website that you're looking at, that focuses on a niche that's really underserved, and most people are not even aware of the fact that what we set them up to do can be done, and that's because there's nobody in the financial industry, in the traditional financial industry, the way it's structured, that's set up, that's incentivized to present this to them. So what we do at 401k Checkbook, we set up retirement accounts. I don't know what you call them down under, but over here there are qualified retirement plans. They come in many different types and flavors. There are just so many. It's dizzying. The overall solution really is to simplify, because really there are very few professionals, a few people that can master them all. So the issue is really structural. I'd like to say seek out a professional that is proficient in all areas, but those are few and far between to find people that are well versed in every aspect of it. And in this space, most people are accustomed. People set up these tax sheltered accounts and then they have these funds that they can't touch without getting penalized by the IRS, so they invest them. And most people think that these can only be invested in liquid securities, in mutual funds. And it turns into a big slush fund for financial advisors that sell stockbrokers or sellers of mutual funds. So in the old model, they were always getting a commission between 4 to 10% of the money that went in every time they sold something to you would be a commission to them. It was great for them. They can churn, one day it's buy this stock, the next day it's buy the other one. And every time you buy something, that's a commission to them. Beyond that, today the asset under management model has become more popular. So if they manage the account, they're generally going to take a percentage of your total assets, whether you make money or lose money. The irony of it is that it's been conclusively proven that most of these folks are actually losing money for you. They're not enhancing your returns. A monkey throwing, the Wall Street Journal did this. It's been proposed that a monkey throwing darts would be better at stock picking or compete. But the Wall Street Journal actually undertook such a study, and they had people just throw darts at the wall each day to select a portfolio, and it outperformed what financial advisors were recommending.
It seems a little bit hit and miss, doesn't it?
And that's precisely the point that they're saying, that it is almost completely hit or miss. Nobody's got a crystal ball, and so for the most part, we've got some folks, Warren Buffett and a handful of others, that seem to have some sort of Midas touch that outperform the markets, but those are one in billions. And even those folks, the statisticians like to say that statistically, if you take a large enough sample, right, you're going to have most of the results are going to congregate around the mean. You're going to have kind of average results, some below, some above, and you're going to have some results at the extremes. So somebody like, when you think about the hundreds of millions of people worldwide that are focused on investing, it's kind of inevitable that somebody's going to have the performance that a Warren Buffett has, even due to luck. And Warren Buffett himself is the biggest proponent of not trying to manage your finances, not trying to pick stocks or time the market.
He's very much the outlier, isn't he?
In terms of his performance, he's the outlier, and he recognizes that. And so he has said that whatever he leaves to his, as an inheritance to his wife or children, the next generations, they should not try to do or duplicate what he's done. They should put it in what they call an index fund that kind of just buys the market. It's diversified, and it just sits there. You don't try to buy that company that you think is a hot stock or some other company that you think is going down. Don't try to short it. Just buy the entire market and let it sit.
Yeah.
But what we do here is what people don't know. In contrast to what stockbrokers and financial advisors do, you can actually take these tax-sheltered accounts in the United States and invest them in real estate, hard money loans, tax liens, life settlements, timber, raw land, cryptocurrency, if you'd like. So you can really invest it in just about anything. But there's nobody out there that's letting anybody know that this is true. And we've got so many clients that come back to us and say, I spoke to a financial advisor and he said, this is illegal. An IRA or 401k can only be invested in stocks or mutual funds. It's certainly not illegal, but that's the amount of misinformation is there. That's because the way the industry is structured, the financial industry is dominated by a few brokerage companies And they've got it automated. You press a few buttons, you buy a stock, you sell a stock. They've made it very easy to transact, which is great for consumers. They've done some great things, but the people that represent them, the retail representatives, they profit by selling these funds, by selling these products. They and the representatives have no way of profiting if you take your tax-sheltered money and put it in an attractive real estate deal. And being that they dominate the industry, it's just most folks are not aware of it. Even somebody that calls himself a financial advisor and focuses on IRAs, on 401ks, and dealing with these types of accounts, nobody ever educates them about all the options that are available.
Do you think that part of this educational process that we're talking about now would be disclosure, talking to the advisors that you choose and say, listen, tell me the story behind how this works for you?
Yes, and it's ironically, you need to get transparency, and to a certain extent, in every industry in the United States, insurance industry, the securities industry, the financial advisory industry, there are certain required disclosures.
Mm-hmm.
But these things can be so convoluted and buried in the fine print that people, you could never find it. You really have to know what you're looking for in order to identify it.
Mm-hmm.
But I think if there's a greater awareness on the part of the consumers, they may be able to get what they want. But the main, being the iconoclast here, the concept, the precept that has to be shattered is that you're really always all on the same side. To an extent, your advisor, he's profiting off your participation in whatever he sells. So you have to recognize that your interests are not completely aligned, and be aware, just be cognizant of that, and always explore your options. Talk to multiple advisors. Today with the internet, you can research so many things. And if you'd like to do something, you shouldn't just ask your advisor and take his word for it. And it's not because they need to be misleading. It's due to the fragmentation. There's certain information that they may not have. Yeah. It's not that they mean to deliberately mislead. It's just that nobody's ever taught them about all the options.
And this is where you start talking about the integrated approach, isn't it?
And yeah, that's really it. In the United States, we have legal entities, limited liability companies, corporations, and then there's the tax structure.
Yep. So
there are S corporations, C corporations, disregarded entities, pass-through entities, partnerships. There's so much complexity. But ironically, what we've seen is the way these interact. Here's one place where it's just a great example of what I'm just trying to describe. Accountants very often coach their clients to form C corporations, or S corporations, to shelter some of their money from taxes.
Mm-hmm.
They may be sheltering money from income tax, or what we have here as payroll tax that goes to the government social security programs, get funded by those taxes. So these kind of structures add a layer of complexity to a person's business and personal tax filings, and they may help them shelter some money from tax. It's great from an accountant's perspective because they get more complex tax filings to do, and they're less commoditized. An individual tax return is perceived as a commodity. When you have these more specialized returns, they're less commoditized, or there's less of that perception.
Mm-hmm.
And then they're able to charge more for those accountants. They're not competing against those mass production tax return mills. Ironically, these tax strategies may conflict with a financial advisor tax strategy. A financial advisor, they focus on these tax sheltered accounts. They may tell a small business owner, you should set up a 401k plan. The ones we focus on primarily are solo 401k plans. Those are 401k plans for the really small business. The business that's just business owners, partners, spouses, no employees, because we can give people the greatest flexibility there. The tax deductions that you can get in those plans range from, can be $55,000, $120,000 per year. Really, really powerful tax deductions that are available using these tax-sheltered retirement plans. But when we've got a client that's got an S corporation, that the ability to deduct that $55,000, the way the accountant has set it up, oftentimes limits his deduction to $25,000. So what the accountant has done to shield taxes has actually conflicted and hasn't enabled him to maximize tax strategies that are presented by the financial advisor. So the analysis is really a lot more nuanced than either the financial advisor or the accountant are aware of. It's bridging that gap has to be bridged.
If I was just coming into this and I was a small business and I wanted to find out the very first step, what would I be looking to do?
The first step is structuring the business. 401k plans, these tax strategies emerge when a company is profitable. And likewise, these complex tax structuring, or more, at least not necessarily complex, but making these tax elections, S Corp, C Corp, those are things that we encourage all our clients when we set up their businesses. Keep it simple at the beginning. You're just starting your business. There's no need to have the drag of all these costs. Yes, if your company is profitable, you're going to need these strategies, and we'll implement them at that time. And what some people don't know, even accountants, is that many of these strategies can be made effective retroactively to a certain extent. But even if in the absence of that, in general, once a company is profitable, the relatively minimal expense of implementing these strategies is just a drop in the bucket. But in day one, when you're getting that set up and you've got all your startup costs, all your organizational costs, and you haven't turned a profit yet, keep it simple.
Yeah.
And then we can always make those tax elections down the line, and there's no need to lock you in. Keep the flexibility.
Yeah. Yeah, there seems to be this need for an ongoing relationship once you've done your due diligence and revealed the truth about the advisor that you choose to work with. Literally creating a working relationship with that individual or individuals is very important, isn't it?
That really is key, because that has the potential to completely change the nature of a relationship. If an accountant or financial advisor or whoever it may be, particularly accountants, they perceive you as coming to them once a year to get a tax return prepared. And oftentimes people don't appreciate the amount of work that may go into a tax return. Come to year end, and they're like, okay, here are my documents, prepare the tax return. And they're not cognizant as that doing a tax return requires at first a complete set of books and records be set up. Your bookkeeping that may have been neglected for a year has to be done prior to your accountant putting together your tax return. It's not part of doing a tax return. And then there's tax strategy. So people will come to they kind of try to get it all at once with their tax preparer. If the tax preparer, I would say it's important to distinguish a tax preparer from somebody that actually knows taxes in and out, the ins and outs of it, and can help you with strategy. But people come to their tax preparer at year end, do the taxes, and they think they're going to get bookkeeping, tax preparation, tax strategy all in one. And that's not going to lead to a great outcome for them. And it also will lead to the tax return preparer thinking, okay, these people come to me once a year. I just have to sell them services. I would love to sell them advice. I'd love to give them advice and be their partner and get compensated for that. But they're not coming to me all year to get advice. They're coming to me, all they want me to do is their tax return. So I may as well get them set up with an S Corp or a C Corp so that they've got to do a business tax filing, they have to do payroll, and they'll have an individual tax return. So I'll have all this work to do for them that I can bill for, and I'll get compensated that way. Rather have, if you change that and you have that relationship, then they won't sell you tax returns. They'll give you advice, and hopefully you'll get the optimal outcome.
Bernard, I'd love to talk a little bit about your URLs, your websites. Where can people find you, and what will they need to do once they get there?
We've got two URLs. One is 401kcheckbook.com. 401kcheckbook.com is completely devoted to our niche business, enabling people to invest tax-sheltered money in alternative investments. We've got an incredible amount of information there compliance, tax, investment. And a lot of what we said is there, including lots of links to many very reputable sites. So everything that we've got there has a citation. If it's a tax question, there's a site from the tax code and the IRS guidance. If it's investment, we've got links to investment research that backs up all that we present here. And we've got agentfinancial.com. We're doing some work there, but that's focused on broader strategies, tax, insurance, and more traditional financial planning that's you won't find at 401kcheckbook.com. That's really there to bring sophisticated tax strategies and introduce a range of strategies, the kind that you generally would have to get a whole team of advisors together. We're bringing it all together in one website, agentfinancial.com. There's going to be a heavy real estate focus, real estate strategies unique to U.S. tax law.
For everyone who's on the call, look around. No matter where you hear or see this post, there will be links back to both of those websites. Bernard, thank you very much for spending some time with me on the My Future Business Show today.
Rick, thank you for having me. It's been great to be with you, and I look forward to being in touch again.
Thanks for joining us today. If you enjoyed the call, then make sure to subscribe, leave a comment, share us with your friends, and book your spot on the show at myfuturebusiness.com/interviews. And if you're looking for solutions that will help grow your business, then visit myfuturebusiness.com/shop.